Hi, my name is Muhammad Haziq bin Maiso. My number matric is 281535, and I'm going to talk about the abstract of our research purposes. The purpose of this research is to investigate the financial literacy for some companies that we had been assigned. This research is focusing on the liquidity for the financial of these companies. Every company has different financial literacy based on the assumption that we make. All the factors, including determinant of financial structure, in this context should also incorporate business circle, as the activities of certain sectors or industry may be affected by economic condition of a country. Basically, this research was interpreting the data into capital structure to investigate the liquidity of financial literacy. Here are some summarized of combination report from this research. Based on the result from data stream, we found some data of industry in Malaysia stock market for the last 11 years, which is corresponding from 2010 until 2020. There are a few steps before interpreting the data given. The first one is raw data method, which is the process of collecting data from data stream, and all the data cannot be used yet as the data was charted. Then the scattered must be cleaned to make the data more organized to interpret it. Cleaning data is one of the process before calculating it. The data must be calculated based on the capital structure of corporate finance. Calculated data is the most important part to our research, which is interpretation is based on the calculated data. After that, the data is ready to analyze. The data can be analyzed into descriptive analysis and interpretation, and result and discussion of descriptive and multivariate analysis. Multivariate analysis help us to analyze the relationship between the leverage and the other independent variable of both sectors. Based on descriptive analysis for overall sample, this analysis is between the dependent variable, which are leverage and short-term debt, and independent variable, which are firm size, tangibility, growth rate, interest tax shield, non-debt tax shield, profitability, and gross domestic product, which is GDP. For descriptive analysis of business circle for factor sample, the leverage of the personal goods is quite good rather than the service good. For multivariate analysis of leverage by sectors, all the variables are counted by 27 companies from personal goods and 27 companies for service goods. Multivariate analysis are also consists of long-term and short-term debt. For multivariate analysis of long-term debt is analysis between the dependent variable of long-term debt and the independent variable, which are firm size, tangibility, growth rate, interest rate shield, non-debt tax shield, profitability, and also GDP. For multivariate analysis of short-term debt, both sectors have a negative relationship between short-term debts and interest tax shield. It means that the company does not enjoy the interest tax saving by generating the short-term debt. Okay, then I will pass to my next presenter.
A very good day, everyone. My name is Hemanantiri Silva, and my matrix number is 283095. And now I will be speaking about literature review. So first up, we have Modigliani and Miller's work from 1958. It might be considered as a significant milestone in the corporate capital structure literature, despite the fact that it has been more than half a century. Academics continue to be inspired, and the number of studies studying company capital structure choice, both theoretical and empirically, continues to rise. The reasoning behind companies' debt to equity mix selection is still a topic of debate. While some companies choose financing, others prefer equity, and despite considerable theoretical literature and numerous empirical studies, the variables influencing this decision remain exclusive. So, second, we have Nissim and Penman from 2003 conducted research to assess the leverage impact that occurred in transactions and leverage effect that did not occur in completed deals. They also considered the effect of all firms' equity rates, often known as profit and after tax. Profitability has an effect on financial leverage and transaction liabilities leverage. According to the study, the price book value rates were also known shown to be dependent on predicted profitability, with the research revealing a negative relationship. The capital structure, as well as profitability and leverage ratio, are all linked. The structure theory was proven correct by Longchen in 2005. Albayrak and Akbulout in 2008 said that using yearly data from 2004 to 2006 to evaluate the elements that impacted the profitability levels of 55 business in the Istanbul Stock Exchange market (BITS) and other service sectors. The dependent variable included things like return on asset, return on equity, profit margins, and profit per share. The liquidity rate, asset efficiency, and capital leverage were employed as independent variables after that. So, growth has a substantial positive association with long term and overall debt, but a negative link with short term debt, according to Hassan Al ETAL 2015. Furthermore, Burgess in 2015 discovered that development prospects have a beneficial role in explaining that. The 2008 financial crisis also caused substantial changes in the factors of market value, growth potential, and tangibility. Furthermore, Ohman and Yazdanfar in 2017 found a positive and substantial relationship between growth, short-term debt, and long-term debt in their research study, implying that small medium firm which has high growth rate choose to utilize more fund. However, Hussein in 2015 discovered that overall debt ratio had a favorable but minor effect on growth opportunity. On the other hand, Thomas W. Halls in 2001 researched into the relationship between tangibility and debt level. This study also emphasizes the need of looking into the physical assets part of the company, which is connected to its leverage and debt level to account for debt maturity. The researcher utilizes the amount of a long-term debt divided by total debt as the dependent variable in another set of models due to the close association between the amount of observed long-term debt divided by total assets, where land transferability is less restricted. As a result, there was a clear link between tangible asset and debt levels, researched by Hall 2021. Next, we have Smith, Jr. and Watts from 1992. The association between liquidity and debt level was another study conducted by them. The current ratio, which known as liquidity ratio, are used to measure companies' ability to pay the short-term obligations. It shows investors how company current assets can be used to repay the debt. Due to the availability of existing assets, the firm may pay down its current debt while still maintaining its long-term economic sustainability. According to these assessments, the company's substantial liquidity will enable it to pay its debt and maintain a healthy debt level, said by Rushidia Hassanuddin in 2021. Next up, Al Ajmi in 2009. Liquidity was significantly negative to short-term debt, long-term debt, and debt ratio, according to them, who investigated a study on capital structure decision of 53 firms in Saudi Arabia from 2003 to 2007. This is a consistent with pecking order theory and trade-off theory. According to the research-based idea, firms choose internal money as the primary source of funding. As a result, companies with sufficient liquid assets can be used this money to fund commercial activities while also reducing their leverage. Lastly, we have Al Bayrak from 2008. It was revealed that the liquidity rate has an effect on the profitability of active assets. Furthermore, the variable, which were one of the determinants affecting return on equity, had a strong positive influence contrary to the predictions. They observed that liquidity, stock turnover, and equity turnover all had a negative influence on net profit margins, which was a complete surprise. The profit margins and the turnover rate for short term liabilities, as well as the link between the activity profit margin and the current rate, was shown to have a comparable relationship. All right. In literature review, lastly we have Agnieszka Bim Powell Pretkiewicz, Paulina Uki Clark, and Rafal Sidlecki in 2015 had undertaken a study on the associations between hospital profitability and debt ratio. The overall debt ratio was determined to be negative in this study. However, the direction of debt related to interest payments was found to be positive. Operating margins were shown to be linked to debt indicators in this study. However, there was a clear link shown between return on assets and overall debt. High profitability, according to the research, will result in a reduction in debt by Agnieszka Bemi in 2015. That's all from me. Thank you so much and have a nice day.
Next. I'm Ang Xinghui, and I will continue to present about the process of produce SPSS. Before doing the analysis, we need to prepare the data that was calculated about 11 variables in Excel file. The data analysis have total 53 companies with two sectors, which is personal good and service good, from 2010 to 2020. First, we need to open the SPSS software and the data Excel file for doing the descriptive analysis and multivariate analysis. To do the descriptive analysis, we click the Analyze and choose the mean in the compare mean. After that, we put the dependent variables in the column of dependent list and put the sector or business cycle in the layer 1 of 1. Besides that, we need to choose the option for adding the minimum and maximum into the self-statistic. After done this step, click the Continue then OK. The descriptive table will be done and shown in SPSS. Next, we also do the multivariate analysis in this study. First, we continue using the data Excel file and click the Analyze, find the regression, and choose the linear. From that, we put our dependent variables, which is leverage, long-term debt, and short-term debt, in the dependent column, and other variables put into the independent. For doing the analysis based on sector or business cycle, we need to put it into selection value. For choosing the value, we click the rules and type the selected sector or business cycle in the value column. Then the result and output of multivariate analysis will show in the SPSS.
My name is Haris Danish bin Zulkifli. My metric number is 289533. So next, I will present about the descriptive analysis. For this table, it shows the descriptive analysis for the sectoral sample. This analysis is between the dependent variable, which are leverage and short-term debt, and the independent variable, which are firm size, tangibility, growth rate, interest tax shield, non-debt tax shield, profitability, and gross domestic product. There are two sectors that have been analyzed, which are personal goods and services goods. The descriptive analysis was calculated by 27 companies of personal goods and 27 companies of service goods. This analysis also calculated from 2010 until 2020. For the meaning of descriptive analysis, it actually measures the central tendency of the data, which are the mean, median, and mode. For this analysis, we are focused on calculating the mean, maximum, and minimum of the variable. The growth rate for the personal good have a better expansion sector than the services good. As compared with the overall sample, the average of personal goods growth rate is still higher, which show the personal goods sector has a very good development. Other than measuring the central tendency, the descriptive analysis also measures the dispersion of data. For this analysis, the leverage of service goods is more spread out than the personal goods. It indicates that the personal goods data are clustered around the mean. In addition, the firm size of personal goods is more dispersed than the service goods. The measurement of central tendency and dispersion for other variables are almost similar. There is only small difference between personal goods and service goods. For this table, it is the descriptive analysis of business cycle for sector sample. It shows that the descriptive analysis for personal goods and service goods according to the business cycle. There are three stages of the business cycle from 2010 to 2020. The first stage was the recession of 2010 till 2013. Next is the expansion stage from 2014 till 2017. And last stage is recession again that happened in 2018 until 2020. This analysis calculated the same dependent and independent variables. For the dependent variable, the leverage of the personal good is quite good rather than service goods. During the expansion stage, the average of personal goods leverage is decreasing. It shows that The personal goods sector managed the debt. However, for the service goods sector, the leverage is increasing from 2010 to 2020. Even though there is any expansion stage in 2014, the service goods sector still has a higher leverage, which indicate higher financial risk. For the independent variables, one of the important variables for every company is profitability. The average profitability of personal goods and service goods according to the business cycle are a little detrimental. Both sectors face declining profitability, although on the expansion stage. The deterioration of the service goods sector is enormous compared to the personal goods sector. It illustrates that the service goods sector has had a bad business transaction along the 10 years. The descriptive analysis for measuring the dispersion in this business cycle can be focused on the short-term debt. The dispersion of the personal goods sector shows otherwise with the service goods sector. The personal goods sector obtained a low standard deviation on the expansion stage and only dispersed a little bit on the next recession. It demonstrates that the personal goods sector managed the short-term debt very well even if there is a recession in 2018. Meanwhile, the service goods sector faced the high standard deviation along the business cycle. The worst case scenario happened when the recession in 2017 created an extreme dispersion that indicate the high risk. This is the descriptive analysis of business cycle for overall sample. It showed that the measurement of the central tendency can be focused on the independent variable, which is the firm size. The firm size measures the total asset, total sales, and market value of equity. The average firm size is increasing from 2010 to 2020. Even though there is a recession in 2018, the firm size is still enlarging. It shows that the firm size on the overall sample gains the leverage to receive higher profitability. When the size of a firm is enlarging, it means the total assets and total sales are rising. The independent variable which are profitability can be measured for dispersion analysis. The standard deviation of profitability for the three stage has only a small distinction. This shows the profitability of the overall sample is very good. It is very reliable for the investor to do an investment in the sector. The value of standard deviation for the three stage is balanced. It means the data for the profitability spread out wisely.
Hi, my name is Tan Ren Xiang and my matrix number is 279651. I'm going to continue with multivariate analysis of the personal goods sector and service goods sector. From the graph of the table above, the interest tax shield of both sectors in the analysis negative relationship with the leverage means most of the company from both sectors are not optimal the interest tax saving and reduce the advantage of debt financing. Moreover, the negative relationship between the leverage and profitability show most of the company are implying the pecking order theory. The mainly use of internal financing more than external financing to achieve higher profitability. The next is the multivariate analysis of long-term debt of both sectors. The table above show the relationship between the long-term debt and the interest tax shield. Positive mean the company of both sectors have fully enjoyed the interest tax saving. This has fulfilled trade-off theory, which the company are balancing tax saving benefit of debt against debt with cost of bankruptcy. Next, I will continue with the multivariate analysis of short-term debt by sector with the independent variable. From the table above, both sectors have negative relationship between the short-term debt and the interest tax sale, meaning the company does not enjoy the interest tax saving by generate the short-term debt. The company of both sectors also implement the pecking order theory, which the short-term debt have negative relationship with the profitability. However, the personal goods sector has negative growth rate with the short-term debt, means the company success to use the short-term debt to increase the asset value. Next is the multivariate analysis of leverage by business cycle. They have three business cycle in our in our study, which is recession in from 2010 to 2013, expansion stage from 2014 to 2017, and the last is the recession stage from 2018 to 2020. From the table above, we can see the profitability of 3 business cycles have negative relationship with the leverage. This means the company are implement the pecking order theory, which the company more common use internal financing to generate profit compared with external financing. During 2010 to 2013 and 2014 to 2017, the company had positive relationship between the tax shield and leverage, which means the company's success to enjoy the interest tax saving and implement the trade-off theory. The relationship between the profitability and the long-term debt are negative, which means the company implement the pecking order theory and less to use the long-term debt to generate profit. However, the company have positive relationship between the profitability and long-term debt in the expansion stage. Next, I will continue with multivariate analysis of short-term debt by business cycle. From the table, we can see the profitability have positive relationship with the short-term debt during the expansion stage, but have negative relationship during the recession stage. The negative relationship is in line with the pecking order theory, with the company mainly use internal financing to generate profit during the recession stage. The interest texture have negative relationship with the short-term debt in 3 business cycle. This means the short-term debt are not in line with trade-off theory, which the company does not enjoy the interest tax saving during 3 business cycle. For conclusion, what we can conclude about this assignment is, from descriptive analysis, profitability is one of the important variable for every company among the independent variable. And for the multivariate analysis, company mostly use internal financing more than external financing to generate higher profitability. However, each company have its liquidation of asset, liability, and profitability based on their own assumption. We are hard to comment on a company because the study is based on the overall data by sector. But what we comment is just the debt level by sector, but not a debt level of specific company. That's all. Thank you.